Hi friends, today we will start with a new topic under the topic investment analysis and portfolio management, and the subject is risk and return, its basic concepts and methods. So let us start. Investment decisions are influenced by various motives. Some people invest in a business to acquire control and enjoy the prestige associated with it. Some people invest in expensive yachts and famous villas to display their wealth. Most investors, however, are largely guided by the pecuniary motive of earning a return on their investment. For earnings returns, investors have to almost invariably bear some risk. In general, risk and return go hand in hand. While investors like returns, they abhor risk. Investments decisions therefore involve a trade-off between risk and return. Since risk and return are central to investment decisions, we must clearly understand what risk and return are and how they should be measured. Return. Return is the primary motivating force that drives investments. It represents the reward for undertaking the investment. Since the game of investing is about returns, after allowing for risk, since the game of investing is about returns, measurement of realized, that is historical returns, is necessary to assess how well the investment manager has done. In addition, historical returns are often used as an important input in estimating future prospective returns. The return of an investment consists of two components: current return and capital return. Current return. The first component that often comes to mind when one is thinking about return is the periodic cash flow, that is income such as dividend or interest generated by the investment. Currently, current return is measured as the periodic income in relation to the beginning price of the investment. Capital return. The second component of return is reflected in the price change called the capital return. It is simply the price appreciation or depreciation divided by beginning price of the asset. For assets like equity stocks, the capital return predominates. Thus, the total return of for any security or for that matter any asset is defined as total return is equal to current return plus capital return. The current return can be 0 or positive, whereas the capital return can be negative, 0 or positive. Risk. You cannot talk about investment return taking without talking about risk, because the investment decisions invariably involve a trade-off between the two. Risk refers to the possibility that the actual outcome of an investment will differ from its expected outcome. More specifically, most investors are concerned about the actual outcome being less than the expected outcome. The wider the range of possible outcomes, the greater the risk. Sources of risk. Risk emanates from several sources. The three major ones are business risk, interest rate risk, and market risk. While a detailed treatment of these sources of risk is woven throughout. Business risk. As a holder of corporate securities, equity shares, or debentures, you are exposed to the risk of poor business performance. This may be this may be caused by a variety of factors like heightened competition, emergence of new technologies, development of substitute products, shifts in consumer preferences, inadequate supply of essential inputs, changes in government policies, and so on. Often, of course, the principal factor may be inept and incompetent management. The poor business performance definitely affects the interest of equity shareholders who have a residual claim on the income and wealth of the firm. It can also affect the interest of debenture holders if the ability of the firm to meet the interest and principal payment obligation is impaired. In such a case, debenture holders face the prospect of default risk. Interest rate risk. The changes in interest rate have a bearing on the welfare of investors. As the interest rate goes up, the market price of existing fixed income securities falls and vice versa. This happens because the buyer of a fixed income security would not buy at its par value or face value if its fixed interest rate is lower than the prevailing interest rate on a similar security. For example, a debenture that has a face a debenture that has a face value of rupees 100 and a fixed rate of return of 12% will sell at a discount if the interest rate moves up from say 12% to 14%. While the changes in the interest rate have a direct bearing on the prices of fixed income securities, they affect equity prices too, albeit somewhat indirectly. The changes in the relative yields of debenture or equity shares influence equity prices. Now the market risk. Even if the even if the earning power of the corporate sector and the interest rate structure remain more or less unchanged, prices of securities, equity shares in particular, tends to fluctuate. While there can be several reasons for these fluctuations, a major cause appears to be the changing sentiment of the investors. There are periods when investors become bullish and their investment horizons lengthen. Investor optimism, which may border an euphoria during such period, drives share prices to great heights. The buoyancy created in the wake of this development is pervasive, affecting almost all the shares. On the other hand, when a wave of pessimism, which is often is an exaggerated response to some unfavorable political or economic development, sweeps the market, investors turns bearish and myopic. There are periods when investors become bullish and their investment horizons lengthen. Investor optimism, which may border, border on euphoria during such periods, drives share prices to great heights. The buoyancy created in the wake of this development is pervasive, affecting almost all the shares. On the other hand, when a wave of pessimism, which often is exaggerated response to some unfavorable political or economic development, sweeps the market, investors turn bearish and myopic. Prices of almost all equity shares register decline as fear and uncertainty pervade the market. Pervade the market. The market tends to move in cycles, and John Trent says that you need to get deeply into your bones the sense that any market, and certainly the stock market, moves in cycles so that you will infallibly get wonderful bargains even few years and have a chance to sell again at ridiculously high price a few years later. The cycles are caused by the cycles are caused by mass psychology, as John Train explains that the ebb and flow of mass emotion is quite regular. Panic is followed by relief, and relief by optimism. Then comes enthusiasm, then euphoria and a rapture. Then the bubble bursts and public feeling sides off again into concern, desperation, and finally a new panic. One would expect large-scale participation of institutions to dampen the price fluctuation in the market. After all, after all, institutional investors have core professional expertise to do fundamental analysis and greater financial resources to act on fundamental analysis. However, nothing of this kind has happened. On the contrary, price fluctuations seem to have become wider after the arrival of institutional investors in large numbers. Why? Perhaps the institutions and their analysts have not displayed more prudence and rationality than the general investing public and have succumbed, succumbed in equal measure to the temptation to speculate. As John Maynard Keynes has argued that factors that contribute to the volatility of the market are not likely to diminish when expert professionals supposedly possessing better judgment and knowledge compete in the marketplace. Why? According to Keynes, even these people are concerned with the speculation, the activity of forecasting the psychology of the market, and not enterprise, the activity of forecasting prospect, the prospective yield of assets over their whole life. Types of risk. Modern portfolio theory looks at risk from a different perspective. It divides the total risk as follows. Total risk is equal to unique risk plus market risk. The risk of the security represents that portion of its total risk which stems from the firm's specific factors like the development of a new product, a labor strike, or the emergence of a new competitor. Events of this nature primarily affect the specific firm and not all firms in general. Hence, the unique risk of a stock can be washed away by combining it with other stocks. In a diversified portfolio, unique risk of different stocks tend to cancel each other. A favorable development in one firm may offset an adverse happening on other and vice versa. Hence, unique risk is also referred to as diversifiable risk and unsystematic risk. The market risk of a security represents that portion of its risk which is attributable to the economy-wide factors like the growth rate of GDP, the level of government spending, money supply, interest rate structure, and inflation rate. Since these factors affect all firms to a greater or lesser degree, investor cannot avoid the risk arising from them. However, diversified diversified their portfolios may be. Hence, it is also referred to as systematic risk as it affects all securities or non-diversifiable risk. So guys, thank you for watching this video. If you enjoyed this video, please like and subscribe to my channel.